duck sound effect?
Aflac.
Come on, do it better than that.
What do you do it better than that?
You do better than that.
Aflac. Oh, you do it then, if it's so easy.
I'm going to ask our guest to do it. Matt Roddy joins us now. Matt is the Vice President and Portfolio Manager at Rockland Trust Investment Management Group. Matt, good morning. How are you doing?
Good morning, Barry. I'm doing well. How about yourself?
So do you know how to do the Aflac sound effect? June was weak. It was terrible.
I don't think I do it that well. I'm probably better at the Yogi Bear impressions.
You like the stock, though, huh?
I do like the stock. Aflac is it's a supplemental insurance company for medical, cancer, personal injury, life, and other insurance needs. And it operates in the U.S. and Japan.
Yep.
And really about three-quarters to 80% of their revenues and 90% of their profits come out of Japan. And recently, a lot of companies have been beating on the earnings front, but not too many companies have been beating on the revenue side as they've been reporting. And Aflac's one of the few companies that did both. They reported the earnings of $169 a share versus $162 recently. And it did beat just slightly on the revenue front with $6.21 billion versus $6.2 billion. Okay. I know it sounds minor, but there has been some yen weakness, as you may have read about or heard about, or your listeners have heard. And really, that held back some of the earnings numbers. The revenue numbers. And those numbers can come up if the yen recovers at all. So, we think it's a good value play, but it does have a growth story, with the potential to grow 8%.
What's the PE on it? I'm looking at my screen. It tells me the PE is only 8-1. That looks really cheap.
It is at 8-1 with an 8% growth rate. That is a cheap stock. It's trading what we call in the industry a PE to growth rate of about 1, which is relatively good. It has a 13% historical 5-year earnings growth rate as well. So we think the stock is very cheap. They've also done some things in their portfolio. As you know, most insurance companies really make most of their money on the net investment income, which is basically the money they can make on the premiums paid over and above the benefits that they have to pay out on the insurance when bad things happen. So, we think the company has the ability to grow at 8%, pays a healthy dividend at 2.5%, and has been growing that dividend for 32 consecutive years.
What about CVS? I saw they did this deal with Pfizer. I think it was earlier this week or late last week. Is that why you like their stock?
Well, I like it for a lot of reasons. They are such a large player, and they do create such synergies and can partner with the drug companies, in such a way through their integrated integrated pharmaceutical business that they have, that it does provide them a lot of operational leverage. And as we know, it's a well-known company here in New England. It's headquartered out of Woonsocket, Rhode Island, and it's done a terrific job doing a lot of acquisitions through the mid to late 2000s. That really made it much more than the retail drugstore that we came to know.
Yep.
Because it does have the pharmacy benefits management business. It also has a really strong new and growing business with these minute clinics that they've offered. So it is really, I think, a good story, and we expect the stock to really grow from here with the projected earnings growth rate of about 13%.
How are they going to compete with the online pharmacies? Because so many people now, you go to your doc, right, and you can, especially if it's a long-term prescription, you're going to go to the cheapest place to get the drug, not necessarily CVS.
Well, interestingly, they actually rolled out a program, I'm going to say it's about a year or so ago, where they've actually offered to match the prices that people are getting online.
Wow.
And it's really driven a lot of storefront revenue. So, it did hurt them a little bit maybe on the margin, but it's keeping the business, coming through the doors and then getting people to buy things at the front end of the store as well. So, that's something that they've thought obviously through, and they've decided to actually match those prices and even some of those 90-day script periods that people are looking for.
How's the nurse practitioner deal working for them in the stores? Anybody using that? Is that making
absolutely? That's the minute clinic I referred to before, and actually the growth rate on that year over year was 50%.
No kidding.
And truthfully, some of that's just due to a really strong flu season, but another part of that is they're expanding the offering. Yeah. A lot of people think about going in there just for their flu shots and whatnot, but now they're starting to diagnose, other minor maladies that people might have. Example being strep throat, being maybe the obvious one. And these nurse practitioners, they're very low-cost alternatives to doctors.
Yep.
And with the Affordable Care Act coming through, there's going to be a lot of need for really, inexpensive treatment options because, as we all know, insurance is good to have, but it doesn't cover everything. Right. And as a lot of these uninsured people come through, into the insurance rolls, they're going to still be looking for cheap, care.
Sure.
And CVS and the Minute Clinic's going to be offering that.
All right. What about Express Script Holdings? This is a $61 stock. Big company now. This is a $50 billion company.
Yeah, it's the actually leading pharmacy benefits manager. It's actually in competition with CVS, who has the second leading private pharmacy benefits management company. Actually, we talked about this stock, not me and you, but someone from Rockland Trust was on here last year, and the stock was trading at $52 a share. And now today it's trading around $61 a share, and we still think it has a ton of growth left. It recently, last year, it closed about 1 year ago today, it closed an acquisition of one of the other leading pharmacy benefits managers called Medco Health Solutions. And that has created unbelievable synergies for this company. In fact, it helped them. They were actually in a dispute with Walgreens at the time, and Walgreens was sort of, I think, refusing to pay up. And once they acquired Medco Health Solutions, they had significant leverage, and the contract with Walgreens got brought back into the fold. And actually, Walgreens same-store sales dipped at that time by 5+%, and so they had a lot of leverage at that point. So we think that combination and they've had some integrations in the past that's done very well. So we believe they can actually integrate Medco Health Solutions and really drive profitability through that to the tune of about a 19 to 20% growth rate.
When are they going to pay a dividend?
Good question, actually. A lot of people think that they could start to pay a dividend, or at least have the ability to pay at a minimum an 80 cent to $1 dividend.
Yeah, they got the money.
If you just look at the rate that their competitor CVS is paying, it would imply maybe even north of $1. But I will say this: they instituted a stock buyback in March of 75 million shares. That's 4.5 billion. That's 9% of the company's float. So, I mean, that in and of itself is a huge return to shareholders.
Yeah, I'd rather see the dividend, though, wouldn't you? Like, if you had to choose, would you choose dividend or stock buyback?
Well, personally, I like the money in my pocket, and I can make a decision from there. But the truth is, there are some tax efficiencies to doing buybacks as well.
All right. Hey, good picks. I appreciate it. Thanks for joining us, Matt.
Thank you, Barry. Have a great day.
That's Matt Roddy from Rockland Trust. His picks were Aflac, CVS, and Express Scripts. Hey, David, have you posted those on our Facebook page? They're going on? All right. Don't go to Facebook just yet. Give us 5 minutes. Go to Facebook, and we will return in just a couple minutes.